Okay, welcome back, my friends. I have taken three really nice dividend stocks here. I've tried to find some stocks that both have a really strong yield, they're strong, financially strong stocks, as well as ones that have been paying dividends for quite a while. It's a good mix of companies. I think there could be something here for everyone to look at. Stick around with me to the end. The last company's got some interesting quirks that I think we really need to consider carefully, and I really am keen to know what you think about these companies. So let's have a look at these three stocks today. Now, let's get into it. Okay, now, whether or not Altria Group and the emphasis on tobacco products is for you, that's a personal decision for you and your families. But this isn't part of my portfolio. It's not one that I'm looking to add, although I have to admit these dividend yields do look very, very attractive here. Now, I'm just going to rip through here on a couple of key points. Yes, triple B credit rated. We can see this beautiful earnings growth here in the orange line and the blue line representing long-term what it's been trading at in terms of price to earnings ratio. Now we can see in the mid 2016, 2017, prices escalated quite high. Since that time they've been coming down and sort of going sideways. So at the moment we're talking about an 8% dividend yield and some fairly high dividend growth rates expected ahead. Now what I can do is I can also flick over to the forecasting analyst scorecard, though I want to have a quick look at the analyst scorecard. So 2-year forward looks pretty perfect, spot on, easy to forecast, and they provide good guidance, and a 1-year forward tends to be very good guidance also when looking at these adjusted earnings. Now the forecasting calculator, if we think about this in terms of a normal multiple, over to the end of 2025, we could be talking about an 18-19% total annualized rate of return, or about a 55-60% total rate of return for us. Now, as we look down here at the earnings growth, it's been fairly constant. I've got this cut off here on the screen a little bit, but fairly constant earnings growth expected by the analysts over time, and we can see an expectation of dividend increases also over time. Overall, is this one to look at? Well, I think if we're looking at this, the long-term growth prospects, there's only a couple of analysts here providing these long-term growth prospects here, thinking about a roughly 5% increase per annum for long-term growth. If that was to come to pass, coupled with the dividend yield, you're probably talking about low sort of 12 maybe percent annualized rate of return, split between capital appreciation driven by the earnings growth and the dividend yield returned to you. Whether or not, again, you're focused on interested in investing in tobacco products, it's going to be a personal decision. And the other one, of course, to think about is tobacco products are heavily regulated in the USA and across many countries in the world. So there's also the opportunity and possibility here of some severe regulatory climate changes which might severely impact, probably negatively impact, the value of your investment long term, or the ability for Altria Group to actually begin to return benefit to you as a shareholder. Now, if you're looking down at the performance, we can see some fairly strong dividend increases here in the past few years. And as well as that, if we look at the compound growth rate, if you made an investment in Altria about 20 years ago, it would have been better than the compound growth rate from the Standard & Poor's 500 S&P SPY index here. For our next pick, we're looking at WP Carry. So this, my friends, is a REIT. So I've got here the AFFO and prices on the chart. So we can see here in orange, since about 2013, there's been a pretty steady increase, with the exception here of the pandemic period, with a bit of an increase since then and some increases here projected into the future. Current dividend yield about 6%. Triple B plus credit rated, and some of the other key elements here to think about as well as the long-term debt to capital is about 45%, which seems pretty reasonable to me. Now, one of the things that I do like to look at is the analyst scorecard here on Fast Graphs. Now we can see here 2-year forward and 1-year forward in yellow. Most of the time the company results managed to match what the analysts were estimating out 1 to 2 years forward, which is always good to see. So it's a stable company, and it's a company where the management appears to provide some pretty good guidance. Now I'm going to switch over to the forecasting calculator. I'm going to take the normal multiple, which we saw in blue was a little bit lower than the orange line, and we're going to have a quick look here at what we might expect going forward. Now, a couple of quick points here. The analyst estimates are here in the bottom row were the estimates for the AFFO 6 months ago. Here we can see the estimates for the AFFO today. And as we can see, they're basically stable. I would say, over the last 6 months, so no major changes in the analyst estimates. Now, this is against the backdrop of the severe changes in interest rates in the USA from the Fed and across many developed nations in the world. So this is a company that seems fairly stable. Now, if we take here 8 analysts supporting to the end of 2024, we're talking about only about a 1.5 increase in AFFO in 2023 and about another 4% in 2024. So we're not talking substantial changes, but couple that with the dividend yield, and we're talking about a total rate of return over the next year and a half or so of about 30%, an annualized rate of return of pushing 18% here, which is not too bad. So this is not going to set your portfolio on fire. It's not going to grow it incredibly quickly, but it's also probably not going to be a dumpster fire either. Now, a couple of key points to think about here. Number one, is this the right time to buy? Now, we can see here this blue line represents the average normal price to AFFO ratio, and we can still see that it's above here despite the price decreases in 2023. So it could potentially go down into even, it looks here, 10 or even 9 single digits perhaps. So it could potentially still decrease quite a way here. So this is not the bottom. I am not calling a bottom, my friends. Another thing to think about is the overall performance. Now, the dividend growth rate here on this column, in the last few years we can see very, very muted dividend growth rates. So again, this is not going to grow your income in the way that Altria Group might. But we can also see the compound growth rate compared to the S&P 500 index since 2009 is very, very comparable. So similar overall performance as the S&P 500, but with a much, much, much stronger dividend profile here. One of the key things I think with WP Carey will be to buy at the right time. Is this the right time? Well, prices, as I say, can go lower, but I think they're at a point here where I think we've got a reasonable price point. I have been picking up some shares personally for the family as a very, very long-term, fairly stable holding in the last month or so. So it's one that I'm continuing to look at and continuing to monitor very closely. Okay, my friends, so for our final company, this is a company, Walgreens Boots Alliance, WBA. It's been on a bit of a downward slide since about 2015. However, it does have a nice dividend yield right now at 6%. It looks as though it's going to be reasonably well covered. We're going to look at that. It has a BBB S&P credit rating. So this is not one that I've invested in. It's one I've looked at several times over the last couple of years since the pandemic. It hasn't had the highs after the pandemic that other stocks have had. We can see also that it came into this period here 20 years ago with a price to earnings ratio of in the 30s. It's been as low as about 10 or 11 several times, in fact, and since 2015 it's really been decreasing, so showing us a very low price to earnings multiple now of 6.7. We can see from the orange and blue lines that there's been earnings growth up until about 2018 and then some difficult years beyond that. Now, one of the first things I like to do is obviously switching over into the analyst scorecard here on the fast graphs. This is one of the things I really do like, where you can see most of the time the analysts do get it right, both 1 year forward as well as 2 year forward, but there's also a number of times where they've been getting it wrong. 2020 is a difficult year, I think, for any company, in 2021, so maybe we can forgive those because of the healthcare related nature of the company. It would have been a very difficult time for them indeed. Now, if we look at the overall past performance, we can see the dividend growth has been very strong in past years as well. So to 10 years ago in particular, very much into the 20% per annum dividend increases, but in the last couple of years, slowing very much into the low single digits. Now, if you see what this means over the last 20 years, the compound growth has been much lower than the S&P 500 stock index, and this has been despite reasonably strong dividend yields and total dividends here as well, which have also been a little bit lagging the S&P 500, and so we can see some pretty challenging times here for an investor over the last 20 years. Now, what is it going to do going forward? Well, we don't know. There is a lot of news about this company, and I think it's really important, if you're going to look at this company, you really do need to dig into what's been going on and some of the risks for this company. But looking through here, a couple of the key points here. The earnings growth has been fairly stable over the last 6 months that we can see here. A little bit of a decrease here for the 2025 year. The dividends are expected to increase marginally into 2024 and then a little bit stronger increase perhaps into 2025. 2023, we've got this downwards change here in the earnings of about 10%, which is a reasonably strong decrease. And that's going to be offset by about a 6% and then a 7% increase in 2024 and 2025. Now, if earnings can return to 9.5, it shouldn't be too demanding. We're talking about potentially a 75% total rate of return over the period to the end of the financial year in 2025 and the end of August, which would be an annualized rate of return of about 27%. Now, for that to happen, a lot of the uncertainty has to disappear. So this is one where you will have to go away, you will have to do a lot of homework here, but it does have good dividend income now, and potentially in the future it might also continue to have some pretty good dividend growth rates as well, depending on how things go. Now, there's a lot going on in this company. It is one that I will do a deep dive on at a later date. Also of interest here, the long-term growth rate. There's only a couple of analysts providing estimates here for the long-term growth rate for the earnings, and a fairly anemic 1.46% expected here by the analysts. So one of the other things to have a quick look at, I'm going to switch down here to just look at the overall sales. The overall sales have been strong and have been growing. They've been struggling, obviously, in the recent years to transfer the sales into earnings. So that's one thing to think about as well fairly carefully. So the sales have been quite strong. Now, whether or not they have a well-covered dividend is another thing to look at here. I'm looking at the free cash flow. This is where I like to see whether or not the dividends are being covered here. And in 2022, 2023, we're talking about a dividend coverage ratio on the free cash flow basis here of possibly only about 84%. So this is one where I believe there could be some potential here, unless things really do pick up in the next couple of years, where the dividend will be at risk of this substantial decrease here in the free cash flow for the company. So that's also one thing I'll be looking out for in the future. Okay, now the final company is Walgreens Boots Alliance, WBA. Now this is a company that I have looked at a couple of times. It's not one that I'm invested in, but it's certainly one that I do keep an eye on. So a couple of really important points to note here. Number one, dividend yield is again relatively high at 6%. We've got a triple B credit rating here from S&P Standard & Poor's. The long-term debt to capital is relatively elevated here, I think at about 53%. We can see from this white line here the dividend payouts that it used to increase quite sharply about 10 years ago, and in recent years it's really begun here to level off a bit. I'm just going to peep over in the performance tab just to see what's been happening here with the dividend growth. And we can see in the last couple of years it's decreased from mid-single digits down to very low single-digit dividend increases here, and that's always something to keep in mind. Now, another point to keep in mind as well, over the last 20 years compared to the S&P 500, it has had anemic compound growth rates compared to the S&P 500. So only 2% compared to S&P 500's 8.6% over the same period. Now, a lot of this hasn't been the dividend per se, but has been the overall total growth of the company and the total return of the company. Now, if we switch back to the historical tab, as we can see, even though in orange and blue here, we can see this beautiful growth up here until 2018. We've seen the price started this period at a very high level here, the 30 times price to earnings multiple. And during the global financial crisis, it dropped down to sort of 12 times. In 2012, down to about 10 times. Then it shot up here again in 2015 to 25 times price to earnings, and it has been trending down since that time. We're now down at about 6.7 times price to earnings. There's plenty of news out on this company. I don't have time to go into this in depth today, but this might be one that I cover in a bit more detail later. But you can see here there's a bit of an uptick here in the analyst expectations. I'm going to switch over to the analyst scorecard to see how well the analysts have been able to forecast. We can see in contrast to the previous two companies as well, the analyst estimates here they've struggled a little bit. Most of the time, the analysts have been getting it right 1 and 2 years out, but there's also been a number of times where the analysts have managed to get it wrong. So it's a trickier company to forecast than the others, and it's also perhaps one where the management team doesn't give such exceptional guidance. Now, forecasting calculators, switching over, I'm going to switch to the normal multiple, which gives us, I think, a slightly more conservative perspective here. Couple of things to look at. Again, the analyst estimates for the price to earnings or the earnings ratio, earnings value here to the end of 2024, we've seen fairly stable analyst estimates here. The end of 2025, we've seen a bit of a decrease here in estimates over the last 6 months. That's something to keep half an eye on, but of course as well, there's fewer estimates here being provided by analysts. They're expecting very anemic dividend growth this year and next year, and again, a little bit more maybe in 2025. Now, one of the big issues here this year is an expectation of a 10% decrease here in the earnings. That's going to be followed by a bit of a bump in 2024 and again in 2025. Now, if we follow this all the way through to the end of 2025, if prices recover to a normalized price to earnings ratio of 9.5, which isn't that demanding if they can get a lot of the challenges behind them, we could be talking about a 75% rate of return or about a 28% annualized rate of return. Right, so what do you think? Are these companies that you have your eyes on? Are they something that might fit into your portfolio? Hit me up in the comments down below. Let me know what you think about these options. Are they something you're going to be looking at? And if not, why not? And is there something else that you have your eye on instead? So, stick with me and we'll get into some more videos soon.